SolarCity is big news today thanks to the planned acquisition by Tesla, but how healthy is the company? Bears and bulls continue to play a tug-of-war game with the stock, but today's guest, Aurelien Windenberger, breaks down SolarCity to show us how many of the fears are worth paying attention to, how healthy the company truly is, and when they will next need to raise capital. Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Invest in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together we want to make the best investments that we can, so thank you so much for joining us. Remember, our goal here is to help you learn to invest financially and in all of life. You can always find more at investorinthefamily.com and subscribe to the podcast at iTunes, Stitcher, or the Google Play Store. As always, if you would like detailed show notes from today's show, simply text the word family notes, one word family notes, to the number 44222, or go to investorinthefamily.com to sign up. We'll be sure to get you taken care of. How much time do you currently spend trying to figure out your investments? Are you tired of spinning your wheels, attempting to conduct research that you really don't have time for? And if we're honest, you might not actually be qualified to do. Brett Jensen is the man behind the Biotech Forum, the number 2 premium marketplace service on Seeking Alpha. He's also a top 5% ranked analyst according to TipRanks. Do you like owning companies that get acquired? So does Brett. Are you anxious about the current election season and how it may impact your portfolio? Perhaps it's time you put a portion of your portfolio on autopilot with Brett as your guide. Visit biotechforumsa.com for more information. That's biotechforumsa.com. SA as in Seeking Alpha, biotechforumsa.com. I hope you enjoyed today's interview with Aurelien Windenberger. Wait, Aurelien, welcome to the show.
Hi, Brian. How are you doing today?
I'm doing great, and I'm looking forward to our discussion today. We're going to be talking about SolarCity, and you can't really talk about SolarCity without discussing Tesla a little bit these days. And so you've written some content about these companies recently. Obviously, it's a very popular topic, and I've had people on the show discussing these companies as well. And I like talking about it because it's fun, it's interesting, but also it's a great chance, I feel like, to learn about investing as well, because whether someone cares about Tesla and SolarCity or not, learning how to understand these companies and invest in them can be applicable in lots of other areas. So I'm excited to have you on the show who spent a lot of time looking into these companies. And anyway, that's way longer intro than I even cared about giving. I'm not sure why I did that, but thanks for being here, and I'm looking forward to our conversation.
Well, thank you, Brian.
Tell me this. Give us just a brief background on yourself as an investor, what you're up to, and then we'll jump into the conversation.
Well, I've been investing for myself for about 10 years right now. I graduated with an MBA about that time, and I've had some good lessons. About 5-6 years ago, I was in one of the reverse merger Chinese stocks. At one point was up 200%, and never really sold out, and so ended up with a loss on that one once it turned out to be a bit of a scam. So that was, a good little piece of education 5-6 years ago. And then more recently, I really got into solar energy, let's say a year and a half ago, 2 years ago. And it's been interesting following that sector just with all the volatility and trying to understand how these companies actually can make money in the long term.
On that note, we're here to talk about SolarCity a little bit. Tell me, there's lots of things going around as far as how healthy or unhealthy they are as a company financially, about their business model and otherwise. Can you shed some light onto the company, how it works, and how they stand?
Sure. So SolarCity, obviously, they have this business model where they will install solar panels on the customer's roof free of charge up front. And then the customer has a lease with SolarCity for 20 years, typically is the contract. And it starts off at a specific rate, which is going to be usually 20 to 30% cheaper than the utility rate. And then they've built in where they assume that the utility rate is going to go up about 3% per year. That's what's been seen to have happened over the last 2 to 3 decades. And so SolarCity's built in that their contracts, the rate also goes up 2 to 3% per year over the length of the contract. And after 20 years, then the idea is that they'll give the customer the ability to renew the contract for 2 5-year periods. And they would be giving the customer a rate that's, I think, 10% lower than the assumed utility rate at the time. And so with this, you're looking at taking, your large sum of money up front, to build each installation, and then taking in cash flows over the next 20 and hopefully 30 years that should, more than make up for the upfront payment.
Of course, I guess the big issue there is there's so much upfront capital, and during those early years, it's just really, really tight financially.
Exactly. And so I actually have one other article that is going to be published tomorrow morning that looks into how, if you have, this type of model, if you're growing the number of installations that you're, adding every year, which SolarCity has. I think they've gone from, 100 megawatts 4 years ago, 150 megawatts, to this year they're going to install probably about 900 megawatts of solar. If you have that expansion, then by definition, you're basically, there's no way to show a profit. You're almost guaranteed to be showing a loss because you're making upfront investments for future gain.
So tell me, you said this year they're looking to install how much again?
Their projected right now is somewhere between 900 and 1,000 megawatts.
And last year was around where?
Last year, I think it finished at about 870.
Okay.
And and so one of the things that's interesting also is this year was supposed to be the last year for the investment tax credit of 30%. It was supposed to expire at the end of 2016. But then last December, it got extended for another 5-6 years. And so what that did is all these solar companies were building up their workforce, putting in the working capital and everything, expecting that this would be, kind of like a big bang year where they had to, or boom year, where they had to get as many installations as possible. But then once the ITC got extended, now, the demand wasn't there anymore because customers can choose to, maybe get it a year or two from now and still get that ITC credit.
Right.
So, in SolarCity's case, they were expecting to install something like 1,250 megawatts or 1,300 megawatts this year. But right now, they've basically guided down to 900 to 1,000 megawatts. And I'm, to be safe, I'm projecting the lower level. And
of course, anytime an investor hears downgrading expectations, even if it's for reasons that make sense, that isn't encouraging.
Exactly. And the funny thing is, of course, that because they're only installing 900 versus 1,250, they're actually going to show a smaller loss this year than they would have if they had done the full 1,250. Of course, from a business standpoint, they would have present value or the future value rather of the installations would have been higher if they'd actually been able to do all 1,250.
Well, and so the reason the losses are lower is because they're not having the extra cost, obviously, of all those installations.
Right, exactly.
When does profitability happen? So they install, say they come to my house, they install all the units, and that's obviously their huge upfront cost. Then all the rest of it is free cash flow in theory for the next 20 years. At what point do they typically expect, okay, we break even at year 6, or is it year like 13 or 14? Do they have those numbers?
Yeah, if you look into it, they actually have some pretty detailed models and this is one thing that I'm, quite impressed with SolarCity about. A lot of people complain that they're, obfuscating facts or information and so forth. But what I've found is if you go to their presentations on their website, they give you, the investors more information than really any other company I've seen, in their quarterly presentations. And so you can actually pull up and look at what their model is for the megawatts that they installed each quarter. One of the big things as well is most people don't really realize, it seems, how the tax equity plays into this whole thing. So SolarCity, they talk about their average cost per watt for making the installations. That cost per watt, it has averaged somewhere around $3 per watt over the past couple years. Because they were they had built up too much for the first half of 2016. It's actually come back above 3 per watt, where the first half of the year it averaged about $3.12, versus last year they were averaging somewhere around 285. But let's say if we just use the $3 per watt as an average, they're actually getting $1.65 to $1.75 of that in tax equity investment upfront. And the tax equity investment, they get paid back on that, not with actual cash flows for the most part, but rather through tax benefits, taking that 30% ITC credit and accelerated depreciation on the units once they're up.
Okay, so if they're paying around $3 per watt, then let me think about this. Okay, and then $1.65 to $1.75 of that is a tax equity investment. So tax equity investment, that's kind of a weird phrase. Is that something where basically is that just basically saying tax credit in a different way of saying that?
Yeah, well, because SolarCity itself, they're showing losses, right? So they would not have any use for the tax credit themselves,
right?
And so what they do is they'll set up these special purpose entities where they come with the project, and then the tax equity investor comes with this, let's say $1.70 per watt in cash, and they combine that. So then the tax equity investor can benefit. They set up a partnership where for the first 6 years, the tax equity investor takes 99% of the tax benefits, and then SolarCity gets 70% of the actual cash flows. And then after 6 years, it flips where SolarCity gets something like 95% of the cash flows. So by setting it up that way, the tax equity investor is putting in $1.70 per watt today. They're getting, in terms of actual cash flows over the contract term, they're getting back something like 50 cents per watt. So less than a third of what they put in, but they still make an internal rate of return of somewhere between 8 to 12% because they're getting all those tax benefits.
Okay, I think we just hit on at least one example on why a company like SolarCity is hard to understand, because that well, from me anyway. I mean, I guess hearing that, like, I think I'm kind of understanding what you're saying, and that we may not need to delve into it very deeply necessarily for the scope of this podcast. But to me, that's an example of why just looking at the numbers for a company like SolarCity can be really hard and misleading, because how do you cleanly express on a financial statement what you just said?
Exactly. And, that's why you really need to look deeply into this. It's funny because SolarCity really isn't it's not like it's super undervalued right now. And I tend to focus on investments that I feel are, drastically undervalued. But I have had this interest in Tesla because I am a huge Elon Musk fan. And then, I've also been interested in solar companies, and SolarCity, of course, a year ago, they were trading at 60. And at that point, they definitely seemed overvalued. When they got down to under 20, then, I kind of perked up and got more interested as, a type of value investor. And so I wanted to see if it actually did make any sense. At this point, it's still not like you're buying it maybe 50 cents on the dollar, but it was, in my opinion, cheap enough that I did take a small position for myself on it.
Right. So let's talk more about the financials and the business model. Is there anything about the business model beyond what you said that would be important for us to know right now?
Well, certainly if anyone that reads anything on Seeking Alpha or otherwise will see, they'll read about all the potential concerns about the business model. And so I don't know, how much we want to delve into those on the podcast.
Let's briefly throw them out, because we're about halfway through right now in terms of time wise. I'd love to hear briefly what some of those concerns are, but I know you've got a bigger point about how much funding and cash they're going to need going forward. And so I want to make sure we've got time for that. So it would maybe hit on some of those concerns, but then focus on kind of your, I guess, bull case for where they're at cash wise.
Right. So, there's many concerns and they're all legitimate. But for the most part, what I feel is I see someone brings up the concern and they assume that the worst case is what's going to happen. And so some of these concerns are, that one, once you reach the 20 years of the contract period, that no one will want to renew again. And that's actually, part of it is because it's going to be a lot cheaper to, say, put on a new set of solar panels on your roof in 20 years than it is today. And so why would someone want to get into, continue on this contract, which is maybe overpriced?
Mm-hmm. And potentially lower quality solar and everything else.
Right, exactly. Now, in terms of the lower quality, to me, the solar power is solar power. You're generating energy, and whether the energy is coming from, a 20-year panel or a new panel doesn't really make much of a difference. What really matters is the amount of energy that is coming out.
Right.
So, certainly it's going to be a little bit less energy, but to me, this isn't like, buying a new computer where the computer itself is pretty useless if you had a 20-year-old computer.
Yeah, it really comes back to the cost issue, essentially, because maybe in 20 years, a panel will have a much greater efficiency, so therefore being much cheaper, and maybe you have a quarter of the panels you would need now. But bottom line is, if those panels are still producing what you need in 20 years, then who cares?
Yeah, exactly. And so, one of my articles that I wrote about this looked into this, and I actually am, very bullish on the cost of electricity for consumers going, into the future. So I actually think we're going to see electric rates come down over the next 20 years. Right now, I think the average around the United States is something like 12 cents per kilowatt hour, somewhere between 11, 13. And then, of course, in high level states like California, it's much higher than that. I wouldn't be surprised if in 20 years we saw, the cost per kilowatt hour down at like 7 or 8 cents. And so if that happened, then SolarCity would, as long as they decided to offer their power from these panels at less than that, then I feel like the customer would, the intelligent move would be to renew the contract. But of course, the amount of money that the cash flow would be much lower than SolarCity currently projects on those.
Mm-hmm. Right. That makes sense.
And so, that's a legitimate thing to consider. But the bears would tell you that SolarCity is going to have zero cash flow after 20 years. And, they also talk about how, let's say going at year, say 15 or 10 or at some point, if electric rates don't continue to increase, SolarCity's rates will be higher. That certainly could play out. But from what I've talked to a few different utilities and, pretty much anyone that's not a SolarCity bear, they continue to feel like we're going to see utility rates continue going up overall, at least for the next 5 to 10 years.
But up in the near term, but potentially down longer term.
Yeah, I think, I'm actually probably I think they're going to go down more quickly than most people think.
Right.
But not quite as quickly as, say a SolarCity bear would imagine.
Sure. So what are some of the primary concerns we're hearing out there for their business model?
Well, that's really the big one, because if the price of electricity did come down too much, then you'd be looking at a lot of people in these contracts, that maybe have another 10 years to go, and they're already paying more than the current rate.
Right.
And so they, that might lead to more defaults and so forth. On the other hand, I think that most people, if they sign a contract, they realize that today they've saved energy or saved money up front. And so as long as they weren't paying, like hundreds of dollars more per year, I feel like they would be okay if they were paying the same rate, towards the end of their contracts. Yeah,
it does fall into the same category. And I made this comment before about Elon Musk and Tesla and his other companies. And I'll make it clear, man, I think his vision for this stuff is exciting. I enjoy following it. I hope things work out great for SolarCity, for Tesla, for SpaceX. But man, it is definitely massively levered, not talking in a financial sense, but man, the long-term component of this stuff, it's either going to be on target and be, man, this is the most brilliant man ever from a business building perspective, or ooh, he did not see that coming 20 years from now. There's not really any way to know. It's one of the things that makes it so crazy, when you're investing in a company so heavily weighted on future benefits and cash flow and everything else. And again, not necessarily a negative, just a very real risk that comes into it.
Right. So, I definitely agree with that. And, on the Tesla side, I see it as even more binary than SolarCity. Because, if they can actually deliver in terms of, making the Model 3 as awesome as it looks like it's going to be and deliver on the price point, and actually deliver it on time, I think that they're going to be very successful. But, right now they're certainly priced for, let's say, close to perfection at this point. Sure. I would say.
Absolutely. Well, let's transition over to the idea of how healthy SolarCity is right now in terms of financing, whether or not they're going to need $3 billion in stock bond financing next year. Some of those things that have been said. I want to hear your thoughts on that, and if we have time, a little bit about how much sense this merger makes.
Right. So, the financing bit is interesting because, again, anyone looking at SolarCity's, statements, balance sheet, and then cash flow statement and so forth, if you're looking at it from a standard company perspective, it makes no sense, right? You like you said, next year it looks like they're going to need $3 billion in either equity or debt investment in order to continue going at the same pace. The key here, of course, is again the tax equity investment. They're looking at the first 6 months of this year, they've brought in something like $650 million in tax equity investment. And that's investment that, as I explained before, those investors are getting their returns mainly from the tax benefits. So, of that $650 million, SolarCity is really only on the hook to pay back something like $200 million over the course of the next 20 years. And really upfront, they're not on the hook to pay very much. So, if you imagine, next year, just with the tax equity investment, you're looking at bringing in $1.4 billion. That knocks down that $3 billion figure in half just with that tax equity investment alone.
Okay, you said so far this year in 2016, they brought in, this is early October 2016, they brought in around $650 million.
Oh, that's actually, I should specify, that's only over the first 2 quarters of 2016.
Gotcha. And then in 2017, expecting about 1.2, you said?
Well, assuming that they have the same level of installations as this year, they're probably going to be around 1.3, 1.4 billion.
Okay. Let's see. But you said they're not keeping all that, right?
Well, over the next 20 years, as the cash flow from these installations comes in, they'll be paying a portion of it back to the tax equity investors.
But point being, next year there's 1.3 billion that's going to be coming in that isn't really reflected anywhere in the balance sheet. So that's going to deeply cut into that 3 billion. But that still leaves almost half of it out there. So what do we do with that?
Right. So the other half, that this is where they can continue to lever the existing installations. So the tax equity, covers at least half, about half of the total requirement. They can then, at this point, the model is kind of unleveraged, and so they can either do debt financing or equity financing for let's say 80 to 90% of the remaining amount. And this is where the bears have really kind of leveled into SolarCity, because the SolarCity's used a lot, that they talk about the net present value of their installations, and they use a 6% discount rate on that net present value. Recently we've seen equity or financing transactions where they were taking out new debt at say 5.5%, 6%, and then this year they've done 2 equity financing deals where the payment was, it's an 8% rate. And so the bears, it makes sense where the bears are wondering what's going on. Why is SolarCity discounting their net present value at only 6%, but then taking on this debt or equity at 6 to 8%? And what's going on here, of course, is that they're only having to take on those rates to cover half of the installation cost. And the other half is coming from this tax equity. And so even though you're paying, more than the discount rate, in my recent article, I kind of calculated that at $3 a watt, SolarCity basically has a 10% internal rate of return, just over, the 20-year contracted period. And so, if you're able to get 10% plus, then you would be happy to leverage that up at 6 or 8%, cost of capital.
Right. So at this point, the $3 billion. So it's the $3 billion number is there's probably a very real need for some new capital injection, but just not nearly as much as people are saying.
Yeah, and basically it's just like the capital that is needed is something that can easily be financed, right? They have these financing tools and avenues where these investors are happy to invest the money at these rates.
Gotcha.
And so the rate might be coming up a little bit because there is a little bit more concern. But then, until they got up above 10%, it's a worse deal for SolarCity, but it's not a deal where the net present value doesn't make sense, where the economics stop making sense.
Gotcha. No, that makes it. That's helpful. So there is still need for capital and cash, but it's not a concern. Essentially, there's opportunities for them to raise that money, and it's kind of like, again, with Tesla, there's concerns over will they be able to fund production of the Model 3 in order to get to that kind of turn the corner, like you mentioned a while ago. And so it's with SolarCity as well. It's just an issue of will they be able to keep enough capital in the system long enough to turn the corner? And as far as we know for 2017, it appears that's not an issue.
Yeah, and the big thing is that people are worried. Oh, Tesla taking on SolarCity, they're going to have to raise $3 billion for SolarCity. And that might be money that otherwise would have gone to Tesla. I disagree with that. I think that SolarCity could be, raising all this money for the most part by themselves. If I was SolarCity, I would be okay with paying, Elon and his cousins 6.5% on that debt all day long, pretty much.
Right. No, that makes sense. Well, hey, Aurelien, thank you so much for coming to the show today. This has been a great discussion. Obviously, you have done your homework, and I honestly would really enjoy just continuing this conversation longer, but maybe we can save that for another day. But for now, this has been very helpful and insightful in terms of where SolarCity stands cash-wise right now, and we appreciate that.
Well, thank you.
Yeah, well, have a great rest of your day.
You too.
Well, hope you enjoyed today's interview with Aurelien Windenberger. And remember, you can get show notes with links into the details at investorinthefamily.com. You can always subscribe to the show at iTunes, Stitcher, or the Google Play Store. And if you want detailed show notes from today's show, simply text the word family notes, one word, family notes, to the number 44222, or go to investorinthefamily.com to sign up, and we'll be sure to get you taken care of. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.